assuming anybody that if you guys have questions afterwards or want to rewatch this, you can always go on the Tri-County Association website. And I believe, correct me if I'm wrong, if you go into the calendar section, you can go back to access video footage of any recorded classes. Is that right, Laura?
It's actually on the education page.
Okay.
But all our recorded classes are there.
Okay, great. Thank you.
Going back forever.
Oh, okay. Well, that's awesome. So a lot of times people message me afterwards. They'll ask me like, hey, Jerry, do you have a recording of the class? So make sure if you just go on Tri-County Association's website under the education page, and you can access this this class. And usually, I think they usually have it up like a day after it's recorded. So you can get access to it tomorrow once it's up. So real quick, I'm going to leave my contact information before we get started. Just leave my contact information in the chat box there. So if afterwards you do want to get together, if you do have questions that you want to just ask me personally, you can get in touch with me. So let me do that right now. All right, so let's go ahead and get started. A little bit about me, guys. Again, my name is Jerry. I'm with Stewart Title. I've been now in the title industry for a little over a decade now, and mostly worked in the San Gabriel Valley area. So many of you on here, some of this call I know personally. So like Janie, I see a couple of names that Marion. I see a couple of people that I know personally. So thank you for being on this call. Today what we're going to cover is, I'm going to cover from everything from the basics of title insurance, right? Because I don't know everybody on this call, so there might be some newer agents. So we're going to cover like what exactly is title insurance, the basics of it, how does it work, what is it, what does it do? And then we're going to talk a little bit about the different vesting methods. A lot of agents have questions about these vesting methods like joint tenants, tenants in common, community property. What is all this and how does it all work? We're going to teach you that so you have a pretty good general idea, I hope, by the end of this class. And then I'll give you some different examples of red flags that's on title, problems that we see, things that come up that needs to be addressed early on in title, and kind of how to avoid a lot of these last minute pitfalls. All right, so that's what we're going to cover on. That's what we're going to spend the next about 45 minutes of our time here today. So let's go ahead and get started. Give me a second to share my screen, and I want to have a little flyer pulled up for you guys. All right, cool. So I hope everybody can see this. If not, please let me know. So let's go ahead and start with the basics, like I said, and that is, what is title insurance? All right. So title insurance says title insurance protects you against covered title defects, like a previous owner's debt, liens, and other claims of ownership that may have been instituted prior to the purchase of your home. What does that even mean? Okay, to put it simply, all title insurance, really, what you need to know is title insurance insures against ownership. All right, that's what title insurance is insuring against, is ownership. So if you purchase something, ooh, I'm gonna mute you here, Libo. I hope you don't mind. Thank you. All right, so title insurance insures against ownership. Now you might ask, why do I need an insurance for ownership? If I buy something, isn't it automatically assumed that it is mine? I'll bring it back up, Tina. Give me 1 second. Isn't it automatically assumed that that ownership of that particular property is mine, right? Like, for example, if you go buy a car, well, you would get insurance for the car, but the insurance is not to insure your ownership. It's to insure that, in case you get into a car accident, that you have money to pay to replace or to repair the cars, right? If you go, so there's really no other thing that insures ownership, right? If you go to Best Buy and you buy a TV, well, you pay for the TV, they give you the TV. There's really no question as to who owns this TV, right? Well, real estate is one of the only things that has insurance for ownership. Essentially, what this is saying is that once you purchase a property, no person, no entity, no lender from the past, right, can come back and threaten the ownership of your new home. So if you happen to buy a house and then after you close escrow and you're the owner of this house, maybe like an old lender, right? The lender for like the seller comes back and say, hey, we didn't get our money and you're the homeowner now, so we want to get paid. Well, that threatens your ownership, right? You can file a title claim. If you purchase a home and then somebody comes knocking on your door and says, hey, I'm the seller's cousin and I actually have, a 20% interest in the house and I never agreed to sell you my house. So technically I still owe 20%, right? So that would affect the ownership of your home. So all these little minor things can possibly affect the ownership. But what if it was fraud? What if the person that sold you your home wasn't the actual homeowner, right? What if they were pretending to be the homeowner? So all these things can affect the ownership of your home. And essentially that is what title insurance is here for. It's to protect your ownership in one of the biggest investments that you make typically in one person's lifetime, all right? Now, this slide talks about how, went a little fast. How is title insurance different from traditional insurance policies? So I talked about that a little bit, right? Most insurance policies work in a very, very similar way. Car insurance, health insurance, life insurance, house, homeowner insurance, it all works in a very similar way. We pay annual premium or maybe a biannual premium in case something were to happen, right? So like, for example, if we have car insurance, we pay a premium every 6 months or every year in case we get into a car accident. Well, title insurance works backwards, all right? So we pay a one-time premium, okay? There's just a one-time premium, and we do all the work up front to make sure or to at least try to reduce any chance that there is a claim afterwards. All right. So we do all the research, we do all the title search, we clean up the title as much as we can at the close of escrow, and then we charge the customer a one-time premium that will last for as long as that homeowner owns the home. So let me repeat that again. The title insurance, the homeowner policy for the title insurance is good for as long as that homeowner owns a home, and there's only a one-time premium that gets paid. All right. Now, there's a little tricky part to this. So I said it's good for as long as the homeowner owns the home. Now, what if that particular homeowner purchases the home and then maybe, I don't know, a year, 2, 3 years later, they change the title to somebody else, right? Let's say I purchased the home, Jerry, and then maybe about 2 years later, 3 years later, I changed the title to my sister's name. Well, guess what? Now, she is the owner, but she does not have title insurance anymore. All right. So there's no more title insurance because it was only good for me. She can then purchase a new title policy if she wants, but if she doesn't, then she doesn't have title. All right. So that's the big main difference. Now, in a typical transaction where a buyer is buying with a loan, all right, there's usually 2 title policies issued. One is called an owner's policy, and the owner's policy is what I've been talking about. All right, it protects the homeowner, protects the buyer. It's good for as long as they own the home. It protects their ownership. That's all this owner's policy. If a buyer were to be taking out a loan, they're also going to be a loan policy, a loan title policy. And this loan title policy is to insure the lender. Okay, it's to insure the buyer's lender. So if the buyer is going to, I don't know, like Bank of America or Wells Fargo or wherever, and they're taking out a loan to buy the house, then their lender is going to say, hey, buyer, we want you to purchase us a title policy as well. Now, why would the lender need a title policy? And if you think about this, it makes sense, right? Because the lender is like, okay, we're going to lend you this, $400,000 or $500,000 for you to buy this house, but we want some type of insurance to make sure that, one, you are who you say you are, right? What if the person buying the home is a fraud, right? What if they're not the actual homeowner or the home buyer, right? So they want to be like, hey, we want to make sure we're lending money to the right person. Also, the lender wants to make sure that hey, if we're gonna give a loan, we want to make sure that there's no other money owed that we don't know about, right? So we're going to give a loan perhaps on the first position, right? So we want to make sure that, hey, there's not going to be any other liens that's going to affect our loan that we don't know about. Because if, say, for example, we give a loan presumably in first position, only to later find out that there's another loan that is first position that never got paid, well, that would affect our loan. So we want to have a title insurance policy that protects us, the lender, as well. Now, this particular loan policy, guys, this is only good for the term of the loan, right? So that's every time you do a refinance, what are you doing? You're paying off one loan and you're getting another loan. So every time you get a new loan, there's going to be a new title policy, and that's the lender policy. So if you've ever refinanced your house, you're going to see on the closing statement a fee for title insurance. Well, that's because you're getting a new title policy, a new loan policy, that is. And it doesn't matter if it's with the same lender. Let's say your existing lender is Bank of America, you get a refinance with Bank of America. Well, they're going to charge you to get a new loan policy. I'll just give you a quick example of a claim that happened. In this case, it was a forgery claim. And many years ago, not that many years ago, maybe like 10 years ago or something, there was a free and clear home out in LA. The home was worth about $8 million. And this $8 million home was paid off. It was free and clear. But the value of it was about $8 million. Well, the homeowners, the actual homeowners, don't spend much time in their actual home. They spend some time overseas in different countries and so forth. All right. Well, what happened was some people we believe to be like criminals and so forth forged fake identities to be the homeowner, and then they went out to get a $4 million loan, a cash out refinance to pull out $4 million on this house using fake forged IDs, pretending to be the homeowner. Long story short, they were able to actually get this loan. They pulled out $4 million and then only to then run away with it and never pay the actual lender because they're not the actual homeowners. So the lender, of course, then was able to activate their title claim and, get paid through their title policy. How long does each policy last? I talked about this already. Owner's policy lasts as long as the owner owns the home, and then also the heirs as well. We'll get it. And the loan policy is only good for the life of that particular loan. That means if the loan gets refinanced, a new loan and so forth, then there has to be a new loan policy. Now, how much does it cost? The owner's policy is based on the purchase price and the loan policy is based on the loan amount. The higher the purchase price, the more expensive the owner's policy, the higher the loan amount, the more expensive is the loan policy. On average, I would say a $500,000 home loan owner's policy is maybe about $1,600, $1,600 or so. Okay. All right. So let me pause right there before I move on to the next section. Does anybody have any questions so far about anything I've talked about before I move on to the title vesting part? Any questions on anything I've mentioned or talked about? Okay, if there's no question, we're going to move on now to the next section, which is going to be on title vesting. Now, title vesting, what is that? All right, so vesting is another way of saying estate planning. Okay, estate planning. And estate planning is essentially what happens to your home after you pass away. So what happens to your asset? What happens to your home after you pass away? All right. So the way that you hold title, your vesting, is going to determine what happens to this particular home if you were to die, essentially. All right. So We'll start with the most basics, and that is one person on title. So there's many scenarios, right? There's one person on title, more than one person on title. So we'll start with the most basic scenario, which is one person on title. If you're one person on title, then it is very straightforward. You're going to be either a single man or a single woman. You can also be an unmarried man or an unmarried woman, or you could be a widow or widower. Okay. Actually, there's one more. You could be a married man or a married woman. All right. So this is all just one person, right? You can be Joe, a single man. You could be Joe, an unmarried man. You could be Joe, a widow, or you could be Joe, a married man as his sole and separate property. Okay, so all these are just one person on title. So let's go over these scenarios. So let's say you represent a buyer, they're purchasing by themselves, and let's say the buyer's name is Joe. Okay, so Joe, a single man, and single man is his vesting. Well, if Joe passes away, if he dies, then this property, it's going to have to go to probate. All right, so probate is a court, it's a California court where basically the state will then determine who will handle Joe's estate. Now here in Southern California, probate is taking quite a bit of time. You know, it's taking maybe about 6 months to a year easily. So we try to avoid probate at any cost, and we can go over some of those details later. Now, the next one is Joe, an unmarried man. Well, an unmarried man is the same thing as a single man, all right? So an unmarried man is just somebody who was once married and is no longer married. So if Joe used to be married and now he's divorced, then he's an unmarried man. And if he dies now, then the property is going to probate. Same thing. Same thing with if Joe is a widow, if he dies now, then the property is going into probate. Now, this one is a little more interesting. Joe is a married man, but he's on title by himself. Okay, so we call that Joe a married man as his sole and separate property. So Joe is a married man, but he is on title by himself. What happens today if Joe passes away? Does the property go to his wife? Okay, it's okay. Nobody needs to answer. And the answer is not necessarily. The property is still going to go to probate. All right. Now, through the probate process, it may go to his wife. It may, but we, meaning the title company, the realtor, the broker, we do not make that assumption. If he's on title by himself, even as a married man, and he passes away, then the property, he's got to go find an attorney and then start a probate case. All right. Now, for Joe to hold title as a married man by himself, his spouse will need to sign a quitclaim deed. All right. So again, if Joe is on title by himself as a married man, his spouse will need to sign a quitclaim deed deeding her interest off title. Now, people might ask me, hey, Jerry, I have a buyer right now. He's married. He wants to be on title by himself, but his wife is traveling in another country. Do we need his wife to sign that quitclaim deed for him to be on title by himself? And the answer is it depends. All right. If Joe is taking out a loan from a lender, then his wife will have to sign the quitclaim deed. No lender is going to allow Joe to take title by himself as a married man if his spouse does not sign the quitclaim deed. All right. But if Joe is purchasing all cash, or maybe he's using like a private lender who doesn't have that strict of a guideline, then he can purchase as a married man, as his own separate, or as a married man, without his spouse signing a quitclaim deed. Okay. Because as long as there's no lender to make that requirement, or if it's like a private lender and they don't really care. The only thing is, sooner or later, his spouse will need to sign the quitclaim deed. So let's say he purchases all cash and he's on title by himself. his spouse doesn't sign the quitclaim deed, that's fine. But when he goes to refinance in the future, or if he goes to sell in the future, at that point in time, his spouse will then need to sign the quitclaim deed. So it needs to happen sooner or later, but if he purchases all cash, then there's a little bit more flexibility for him. Any questions on that? On just one person being on title? Because we're going to move on to when there's more than one person being on title. That's a little bit more complex, but here we go. All right, so when there's more than one person that's being on title, then the buyer has to choose between these 4 different options. Okay, I'm sure you guys, everybody have seen all these 4 before, all right, but we're going to go over these 4 in a basic overview. You don't need to know the details of every single option, but you want to know enough about the major difference so you can advise your client what's the big difference and then allow them to choose on their own. Again, you don't want to be the one choosing for them because then you would be giving legal and tax advice. You don't want to do that. But as their agent, you do want to be able to kind of give them the main differences amongst these options and then, allow them to choose by themselves. All right. So let's go over some of these. If your client tells you, hey, Tina, I'm buying a property, it's going to be me, party A and party B. And you know what? I want to have 70% and B wants to have 30%. If they tell you something like that, they want to have different interests, then the only option to choose is tenants in common. Tenant in common is the only choice that allows co-owners to have different interests. Okay, so right here we can see ownership can be divided into any number of interests. So it could be 90-10, 60-40, 25-75, doesn't matter. The only option to do this is tenants in common. So that makes it very easy. The only thing with tenants in common that you have to realize is that tenants in common does not have a right of survivorship benefit. It does not. So that means if party A passes away, all right, if party A passes away, then party A's interest will end up going to probate. So if you are a real estate agent and you're taking a listing and the owner tells you, oh, maybe one of the owners or my husband passed away, right? That was on title. First thing you're going to want to do is call me, and then we're going to check to see how they held title. Because if they held title under tenants in common, then that person's interest is going to have to go to probate. And this sale that we're hoping to close very quickly may not be able to do so very quickly anymore. All right, moving on to joint tenants. Joint tenants is almost a complete opposite as tenants in common. So any number of people can be joint tenants, but they all have to hold an equal interest. All right. So if 3 people are on title as joint tenants, everybody is on there equally. There's no different interest, no 70-30, 80-20, nothing like that. But joint tenant does have a right of survivorship benefit. All right. It's an automatic right of survivorship benefit. So let's say A and B are on title together as joint tenants, and then A passes away. Well, then B owns the home. That's it. B owns the home. You do have to file some paperwork. You have to record what we call an affidavit of death and then a copy of the death certificate. But essentially, it's a very easy paperwork process. So again, if you're taking a listing and then your seller tells you, hey, my husband passed away, he was on title, and then we check title and it says it's joint tenant, then we're good. All right. All you need to do is ask for a copy of the death certificate, a certified copy of the death certificate, and that's it. We'll take care of the rest from there. And anybody can be joint tenant, husband and wife, friends, sisters, cousins, acquaintances, anybody can be joint tenants with each other. The last 2 we're going to see here, community property and community property of right of survivorship. They're actually almost identical. To save some confusion and clarity, I'm only going to talk about this last one, community property of right of survivorship. All right. And that's the one that I've noticed a lot of husband and wives, a lot of spouses are choosing community property of right of survivorship now. So community property right of survivorship is actually very similar to joint tenants. There's a couple of key differences, all right? So with community property right of survivorship, it's only reserved for spouses, okay? So only for spouses. It's the same in that it has to be equal interest, and it's the same in that it has to, there's an automatic right of survivorship benefit. So let's say husband and wife, A and B, and then A passes away. Well, then property goes to B. That's it. Just like joint tenant, okay? Then you might ask, well, if it's so similar to joint tenant, why is it that sometimes people would choose, a married couple would choose joint tenant, and then sometimes they would choose community property right of survivorship? What's the main difference? All right. Why would somebody choose one over the other? Well, again, joint tenant has been around for a long time. Anybody can be joint tenants. So a lot of people choose joint tenants out of convenience. All right. But there are some more benefits for husband and wives to choose community property right of survivorship. Again, we're not here to tell people what to choose, but simply stating the facts. All right. So with community property right of survivorship, the reason why I think I am seeing a lot more spouses choosing this option is because there's a better tax benefit, okay? There's a better tax benefit. And we're going to talk about that tax benefit right now. So if party A and B are on title as community property right of survivorship, they're going to get a better tax benefit if one of the party were to pass away and the other one sells. Okay, it has to do with capital gains tax. It has to do with this thing called a step-up tax base, right? So let me explain this. It's a little bit confusing, so I'll use very simple terms to explain it. So let me erase all this. Start over. So step-up tax base. And this has to do with capital gains. Okay, so we're going to be talking about step-up tax bases, and it has to do with capital gains. All right, so we'll do some very simple, easy examples. Let's say somebody in the year 1990 purchases a house for $100,000. Today, that same house is worth $1 million. This is the fair market value. Okay, let's simplify our example. I know that on the primary home, if you sell, you get to exempt $250,000 for property tax, or not property taxes. You get to exempt $250,000 from your capital gains, or $500,000 if you're married. Let's just forget about all of that, okay? We're just gonna keep it very, very simple for the sake of our example. Now, if somebody buys a house in 1990 for $100,000, okay, this is going to be their base. And today, that house is worth $1 million. If that person sells a house, they're going to make $900,000. That means they would have to pay capital gains tax off $900,000, right? It makes sense. So but let's talk about step-up tax base. This is how step-up tax base works. Let's say party A and B, husband and wife, purchases a home as community property right of survivorship in the year 1990 for $100,000. All right. So again, husband and wife, community property right of survivorship, purchases a home in 1990 for $100,000. Today, all of a sudden, in 2021, the husband goes out, maybe he's driving, he hits a tree, and then he dies. Well, what's going to happen is the base value is going to step up to the fair market value on the day he dies. Let me repeat that. The base value is going to step up to the fair market value on the day that he dies. So this will then be our new base. So if the husband dies today, this will be our new base. So let's say the wife is very sad. She decides that she doesn't want to live in the house anymore. She puts the house on the market. She gets it in escrow for how much? Guess what? The market value, $1 million. So her new base is $1 million. She sells for $1 million. There's zero gains. There's zero capital gains that needs to be paid, right? If she sells for 1.1 million, like a year later, well, guess what? There's only a $100,000 gains in that sale because the new base is $1 million. All right. So that's how step-up tax base works. All right. And it does apply to community property and community property right of survivorship. So that's why it's such a very popular choice for spouses. Now with joint tenants, you also get a step up, but I think you only get a partial step up. You don't get a full step up like community property and community property right of survivorship. Again, that's the very basics of it. If customers have questions, they should definitely talk to an estate planning attorney or maybe a CPA to kind of give them the details of it. But that's essentially how the step up tax base works. And it's a very, very powerful tool because it even applies to trust. For example, let's say if you're the beneficiary of a trust, right? So the trust is maybe owned by your parents and then you're the beneficiary. Well, once the parent passed away and maybe if you inherit the house through the trust, you're going to get a step up as well. So this step up tax base is a very, very important concept that can be applied into different number of situations. And the other one I want to talk about, it's not on the chart, but it's relating to trust. Okay, so we're going to spend a little bit of time talking about trust here. So trust is another way of holding title that's not on the flyer, but you can hold title under trust as well. All right. Now, all trusts, they work in a very, very similar way. Some trusts are complicated, some trusts are simple, but all trusts have these roles within the trust. And those roles are your trustor, trustee, and beneficiary. Okay. So trustor is who owns this trust, right? So if my wife and I, we go create a trust, we tell this attorney, hey, attorney, we want you to create a trust. So one day, if we were to die, then this person would be in charge. And then these are how all our assets will be divided, et cetera, et cetera. Like this is our instructions as to what happens to all of our stuff one day when we're not around, right? We own this trust. Then we are the trustors. The trustee is who manages this trust, right? So now we've created all these instructions. Well, who's going to manage all this, right? Who's going to manage this trust? And that's going to be the trustee. Now, usually speaking, when the trustor is alive, they will make themselves the trustee. They don't have to, but that's the most common way we see people do it. So if my wife and I, we go create a trust, we are the trustor, then most likely we're also going to be the trustee. Okay, again, it doesn't have to be, but that's how we see it most of the time. And then the beneficiary is pretty self-explanatory. Who are the benefactors of this trust, right? If it's a family trust, most oftentimes it's the children, right? So my wife and I, we have a trust and we have a son. So the beneficiary of our trust is our son. So one day, if we're not around anymore, he's going to inherit a lot of our assets and so forth. So those are the main three roles of the trust. So let's talk a little bit more about the trustee, all right? The trustee, if you take a listing, is the person who's going to be signing everything, all right? So if you take a listing and titles under trust, and then you see that the trustee is somebody named John Smith, then John Smith, the trustee, is who's going to be signing all of your contracts, who's going to be signing the grant deed, and so forth. Now, if John Smith, the original trustee, has passed away, then we need to determine who is the successor trustee. In that situation, then we need to look at the trust. The title company is going to ask the seller for a copy of their full trust to review. So then we can actually determine who is the successor trustee of this particular trust. All right. And then that person is then who's the one that can sign everything, your contracts and your grant deed. So guys, if you are taking a listing and then you find out the seller is a trust, all right, and the original trustee has passed away, sign that listing with whoever is called you. But immediately you want to say, hey, I need to get a copy of their trust so we can review. Because what you don't want to happen, and this has happened before, is that you go through the whole escrow process, but you only get the trust very late, right? Like once we get into escrow. But guess what? We review the trust and we find out that the successor trustee is not the person that you've been speaking with, that they do not have authority to act on behalf of the trust. And then guess what? the listing is done because the actual successor trustee doesn't want to sell the house. So it's happened before. So make sure as soon as you take that listing, if the original trustee has passed away, that you immediately request for a copy of the trust so we can help review for you to see who is the successor trustee. All right. Now, a couple more things about this trustee situation. All right. So there's a number, if the trustee cannot act, there's situations sometimes where the trustee cannot act. All right. They cannot perform their duties, either because maybe they're dead, or maybe because health-wise, or they're not very good, right? Maybe because mentally they have Alzheimer's or so forth. So again, in those situations, we also need to review the trust. In most trusts, there is a provision in there that states what happens when the trustee maybe has Alzheimer's or is mentally not capable of acting. Many times we see those trusts will say like, hey, we need, if the trustee is unable to act for whatever medical reasons, then there needs to be 2 doctor's notes, right? And then if 2 doctor's notes can confirm that the trustee is unable to act or is not mentally stable, then the successor trustee can then step up and perform the trustee duties. Again, the 2 doctor's note is just an example, but it's a very common example. A lot of trusts that we see states that 2 doctor's notes. And why am I telling you guys this? Because we run into a lot of situations where maybe the trustee is very old. There may be I had a file that last year where the trustee was in Taiwan and he was very old and not in good health. And he was unable to really act and sign anything. He wouldn't even know what he's signing. Like, he's not in a good position. So the successor trustee came, the actual successor trustee said, hey, we need to sell his house, right? I am the successor trustee. Here is the copy of the trust so you can verify. And we verified that, yes, he is a successor trustee. But in the trust, it says that they need 2 doctor's notes, all right, to verify that the original trustee cannot act. Well, guess what? They can only get 1 doctor's note at the time because it was during the pandemic, all right? So they were only able to get 1 doctor's note, not 2. So they said, hey, Jerry, we can only get 1 doctor's note. But at that time, I said, guys, my hands are tied. The trust specifically states there needs to be 2 doctor's note, and you have to get 2 doctor's note. And until you do, we cannot continue with this transaction because we have to follow what is stated in the trust. All right. So all very tricky little things to watch out for. Now, what else about a trust? The other thing about a trust is that if you have a trust, you have to make sure you change the title of the property into the trust. This is the part that a lot of people miss, is they go to an attorney and the attorney helps them create this trust. And then they think that that's it, I'm done. But they're not done. They have to change the title of the home into the trust. So the homeowner has to change from John Doe to the John Doe Family Trust, or whatever the name of the trust is, okay? So there has to be a deed recorded going from the individual to the trust. I just met with an agent last week. She just learned about this, and she told me, you know what? My dad created a trust like last year. I don't know if he ever changed the title of his home into the trust. So we checked, and indeed, he did not. So she brought me like his entire trust document package, and we looked through all the documents, and guess what? In there was an unrecorded deed going from the dad to the trust that never got recorded. All right. So if the dad were to go and accidentally, for whatever reason, pass away right now today, then guess what? That property still goes to probate. And this is exactly what happened to a file that we closed last year for a property in Walnut. Is that a mother who had a trust, she passed away. The son was a successor trustee. The son listed the house, put it on the market, got it into escrow, only to then find out that the property was never put into a trust, right? And then they still ended up, and this property could have closed escrow in probably 21 days. I mean, it would have sold really fast, but they got it into escrow, found out that it was never put into the trust, right? And so the son, he doesn't have a lot of the paperwork of his mom. They still ended up going to probate. And then through the probate, finally, the court put the title into the trust, which then allowed the son to act as a successor trustee. That took maybe 4 months. All right. So where originally he thought he could close this file in 21 days, ended up taking 4 or 5 months just to do. And that was fast. That's actually fast for a probate case to kind of to do that. So make sure if you have a trust that you do that, or that you remind your clients about that. All right. The last thing I want to talk about this vesting is you can also hold title under companies, so like corporations and LLCs. But if you do, when you sell title companies, we need to review all those entity documents, like your operating agreements or your bylaws, to know who can sell on behalf of that company or entity. All right. So I'm going to stop right there. Any questions on any vesting things I talked about so far? Will that recording change the house value to market value? So Tina, that's a really, really good question. So what Tina is referring to is that, you see, anytime that there is a transfer in title, and it doesn't matter if it's a gift transfer with no value or if it was a sale transfer, the county assessor can reassess the property taxes. And so the property taxes could possibly go up. So they can reassess the property taxes to the fair market value. The only time a transfer does not trigger a reassessment is, there's a couple of scenarios, is if you're transferring to yourself. Okay. What I mean by that is, let's say I'm transferring to my own trust or something like that, or an entity that I own. Jerry is transferring to the ABC LLC, of which I am the only member or manager, right? In those types of scenarios, the property taxes does not get reassessed. All right. If I transfer to my own trust, I believe it shouldn't get reassessed either. But if I'm transferring the title to, or actually, I'm sorry, I'm not done. If it's a between spouses, if it's a transfer between spouses, then it also does not get reassessed. If it's a transfer between parent and children, or grandparent and grandchildren, this is a tricky one. You might have heard about Prop 19, right? So before, it used to never get reassessed as long as you fill out a form. Well, now it still might be reassessed, but you might be excluded if you meet some certain conditions. So that's a little bit more tricky. We can get into that on a separate note, because Prop 19 itself is actually quite more detailed and complicated. But any other scenarios, let's say I'm transferring to my sister, I'm transferring to my brother, I'm transferring to my friend. Doesn't matter if it's a sale or if it's a gift, it's going to be reassessed. All right. Good question. Anything else, Tina, or anything else, anybody? Okay, awesome. Well, let me just wrap up with a couple of title tips for you guys, and then we'll leave the last few minutes for questions, and then we'll wrap it up here before 11 o'clock. So I'll give you a good title tip that you guys can apply to any file that you're working on. First thing is uninsured transfers. Okay, uninsured transfers. So this is a very, very common thing that we see in our industry. So what is an uninsured transfer? Let's say today, Tina buys a house, right? And then maybe 2 or 3 months later, Tina decides to sell or transfer, not even sell. She's just going to transfer it to Marion. Doesn't matter why, doesn't matter. Okay. She just says, you know what? I'm going to change the title of my house and I'm going to change it to Marion's name. And then she signs a grant deed in front of a notary, gets it recorded, and now it's under Marion's name. It's a perfectly legal thing to do. Now, Marion owns a house. She then, maybe a year, 2 years, however long later, she puts it on the market, gets it into escrow. While the title company is going to see that there was an uninsured transfer, meaning there was a transfer that had no title insurance policy between Tina and Marion. So what is the title company going to do? The title company is going to say, hey, I need Tina, all right, to sign this affidavit in front of a notary stating that she did actually do this transfer to Miriam. Right, so she's going to say, Miriam, I need you to go back to Tina to have her sign this affidavit, even though she already signed a grant deed. I need her to sign this affidavit stating she did really do this transfer. Why are they asking for that? The reason why they're asking for that is fraud prevention. Okay, because what if Tina didn't really sign that deed? Right? What if Miriam forged her signature? All right. What if Tina, when she signed that deed, she was under the influence? Or what if Tina was a very, very old person? I'm sorry, Tina, I don't know how old you are, but what if Tina was a very old person and she had no idea what she was signing, right? We see that a lot in elder abuse, right? We see that a lot in elder abuse. So for example, if, a mom has 5 kids, one of the kids might manipulate the mom to sign the deed over to them, just to one person, so they can sell the house. So all these things are potential fraud issues that can result in lawsuits. So title companies needs to make sure that, hey, everything was done correctly. Okay, so you need to. So the problem comes up because a lot of times these, party A, they'll be gone. We can't find them. They won't sign. They're out of the country. It's been 5 years. It's been 4 years, and so forth. So always make sure that you remind your clients, yes, you can change title. You can change the title. You can remove somebody from title, but that's an uninsured deed. And when you go sell in the future, the title company is going to ask that person that gave up or that came off title to sign an affidavit. So that's one good title tip. Another good title tip I want to share with you guys is a statement of information. When you take a listing with your client, all right, I advise to always contact your title company, whether it's myself or another person, to order a preliminary title report. The preliminary title report is going to show everything that's affecting title at that time. But that search to see if there are any liens, it's not really completed until the seller provides us with a statement of information. And the statement of information is just a 1 or 2 page form, asks them for their name, their social security number, their date of birth, where they've lived, where they've worked. And the reason why we ask for that is because there are certain liens that can only be found through the information on the statement of information, right? For example, if the owner has an IRS lien, well, the IRS doesn't necessarily know where you live or all your homes. So they're not going to put a lien on every single one of your homes because they don't necessarily know every single home you own. But they just know that, hey, if you sell something and you owe us money, you better pay us. So they're going to put a lien on that person, right? So they're going to put a lien on that person. So some liens can only be found through the statement of information because it's attached to that person, and we need their social and their date of birth and so forth to find those liens. Another reason is because there are people out there with very similar names, right? So I'm sure I'm not the only Jerry Wu, right? So if I sell my house, there might be another Jerry Wu that owe money to the IRS. How is the title company supposed to know which Jerry Wu is it that owes money to the IRS? Is it me or just somebody else with a similar name as me? So again, that's why we need the information on the statement of information to verify who actually owes this lien. Is it me or is it just somebody else that has a similar name as me? Okay, so statement of information, I always recommend agents, you get it as early as you can when you take the listing. So when you take the listing, get your prelim from your title company, and then submit that statement of information in to your title company as soon as possible. All right. So a couple more minutes left. I'll give you another good tip, property taxes. We are currently right now in property tax season, all right? So property taxes can be very confusing. But one thing to help you understand it a little bit better is you have to understand the timeline of property taxes. And the most important thing to understand is, when does it start? So it's a fiscal year, okay? So 1 year in the property tax, it starts on July 1st. It doesn't start on January 1st. It starts on July 1st of this year and it ends June 30th next year. So currently we are in the 2021-2022 tax year. So July 1st, 2021 is the start, and it will end June 30th, 2022. The first half will be delinquent on December 10th. All right. If you are currently in escrow right now with a buyer, and it's going to close maybe next month or maybe within the next month or two, chances are the first half property taxes is going to get paid through escrow. Okay. It's going to get paid through escrow. So that means your buyer is going to be responsible for the second half because the second half will not have been paid. However, your buyer is not going to get a property tax bill for the second half. The county only mails out the property tax bill once a year. So that means your buyer, they have to remember to pay the second half property tax bills by themselves before the second half deadline, which is April 10th. This year it's actually April 11th because April 10th, I think, is a weekend. So you have to remind your buyers, make sure you go online and pay your property taxes for the second half before the April 11th cutoff. All right. So that's very important. They're not going to get a property tax bill. So often, it's very unfortunate. I get a call from one of my realtors. They're like, hey, my buyers just got a delinquent property tax bill. And they're saying like, it should have been all paid through escrow. I thought it was all taken care of. It wasn't taken care of. The other thing that you want to pay attention to is an impound, okay? If your buyer is impounding their property taxes and insurance, that means they have their lenders paying the property taxes and insurance. If they are doing that, the first year that they purchase the house, they're not only going to have a regular property tax bill that the lender will pay, but they're going to get a supplemental property tax bill. And the supplemental is because of that same reason Tina just mentioned, is because there was a transfer, the property taxes got reassessed, it's higher, so there's a difference. So that difference is the supplemental property tax bill. The supplemental property tax bill is not paid through the impound. Okay, so a lot of the times the buyers will make that mistake. They think they'll get the supplemental tax bill, okay, and then they won't pay it because they're like, oh, okay, my property tax is already impounded, the lender will pay it. The lender does not pay that supplemental property tax bill. So if you don't pay it, you will get a delinquent bill later on. And it happens very often. So make sure that you teach and educate your customers on that. All right. I think that we're going to end it right here. I'll do a quick little commercial if you don't mind. If you guys enjoyed this information, I hope it was helpful. If you guys need any title tools or resources for farming, to pull property profiles, to review prelims and so forth, please feel free to reach out to me. We have a lot of different resources catered towards realtors to help you guys in your business, to provide you tools to make you more efficient, to help you guys in your day-to-day as well. Does anybody have any questions before we wrap up this class? Okay, well, what I'm going to do, let me leave my information in the chat box one more time for anybody that might have missed it earlier. So if you do have questions, feel free to reach out. Let me type that right now. There you go. So my information is in the chat box. Feel free to let me know if you guys have questions. And guys, if like I said, I hope this information was helpful. If we have the chance to work together in the future, please feel free to let me know. I'd love to earn your business. I'd love to work with you on your next transaction. And with that, have a good rest of your Thursday. All right, take care.